Hi everyone, and welcome to Learning Objective 1-1. So in this learning objective, we're going to discuss the concept of cost allocation as it relates or as it pertains to property, plant, and equipment, and also intangible assets. All right, so what are we talking about when we say cost allocation? Well, if you remember at the end of Intermediate Financial Accounting 1, we talked about this idea of cost capitalization. So when we capitalize costs, what we're saying is that when we incur a cost, right? Let's say, for example, we're running Explorer's Den pizza, right? And we need a new pizza oven, right? And then we buy a new oven for the shop, and that new oven costs maybe $20,000. Probably pretty expensive to buy a pizza oven. I don't know. But let's just say it's a big expense. We spent $20,000 on the new oven, and we're going to use this oven for a significant period of time. In other words, we're not going to use it one time and throw it away. We're going to use it maybe for 2, 3, 4, 5, 10, 15 years. Who knows? But we're going to use this asset, right? Because it meets the definition of an asset. The oven will generate future economic benefits for us. We'll be able to use it to make pizzas that we can sell to customers. So it meets the definition of an asset, and it provides future economic benefits. And so rather than saying that $20,000 cost that we incurred is an expense this year in this year's income statement, we're going to capitalize that cost. We're going to put that cost on the balance sheet as an asset. We're going to record an asset for the oven rather than recording an expense in the income statement. All right, so that's what we do up front. But that cost, at some point, it has to become expense. At some point, we have to record this cost as expense in the income statement. So how do we do that? Well, what we're going to do is we're going to allocate that cost. We have cost allocation. We're going to take that initial cost, and we're going to spread out the cost over the useful life of that asset. So if we're going to use this pizza oven for 10 years, we're going to take that initial cost and we're going to record that initial cost. We're going to spread it out. We're going to allocate it over a period of 10 years because that's how long we think the oven will last. So that's what we're talking about here in Module 1 of Intermediate 2. Module 10 of Intermediate 1, we were saying, well, how do we record the initial purchase of the asset? How do we capitalize that cost? Here in Module 1 of Intermediate 2, we're saying, okay, now that we've capitalized that cost, what happens going forward? And what happens going forward is we allocate the cost going forward. And we're going to call that cost allocation depreciation. All right, so you should be very familiar from your previous accounting classes with this concept of depreciation. Now, what's the formula for straight line depreciation? Straight line depreciation is you take the asset's value, you take its scrap value or its residual value, what you think you can get for it when you get rid of it at the end of its life, and you take that value, so the original value minus the residual value. So we have a pizza oven that cost us $20,000. At the end of 10 years, we think we can sell it for $500 for the value of the metal that is in the oven, right? So we're going to take 20,000 minus 500, so 19,500. We're going to spread that cost out over a period of 10 years. So we're going to record $1,950 of depreciation expense per year, and we call that straight line depreciation. Now, there are other ways of calculating depreciation, but by far the most common is straight line depreciation. All right, so that is the first cost allocation concept. We're also going to be talking about things like impairments of assets, okay? But for now, just keep this idea of depreciation in your head. Now, depreciation is a cost allocation term. It's the way we allocate the cost of a property, plant, and equipment asset over its useful life. But let's say we have an intangible asset. If we have an intangible asset like a patent or a copyright, we also have to allocate that cost over the useful life of the patent or the copyright. But when we do it for an intangible asset, we are not going to call it depreciation. We're going to call it amortization. So we're going to have amortization for intangible assets, and then we're going to have depreciation for property, plant, and equipment assets. Now, there's one other term that's relevant here, And this other term is depletion. Depletion. D-E-P-L-E-T-I-O-N. Depletion. So depletion is what we call depreciation if we have a natural resource asset, if we have something like an oil well. So we're going to call the cost allocation on a natural resource asset, we'll call it depletion. So we have three terms here. They all mean the same thing. They all relate to cost allocation. And so we have depreciation for property, plant, and equipment assets, depletion for natural resource assets, and amortization for intangible assets. Okay, so three different terms there. So are there any major differences between those three? No, just different terminology that we use for this cost allocation concept. So what do we do with, so here with these cost allocation terms, we're talking about allocating costs for an asset that we capitalized that has a fixed life. We know that the oven, for example, is likely to last 10 years. We might be off a little bit. It might be 15 instead of 10, but for the most part, we know it's not going to last forever. But what do we do with things like goodwill? If you remember from Intermediate 1, goodwill was this idea, it's this fake asset, right? So it's a fake asset. It's the difference between what a company spent to buy another company, what Apple spent to acquire Beats in 2014. It's the difference between the price that Apple paid and what Beats' balance sheet said it was worth. Okay, so goodwill is the difference between the purchase price of a company and the balance sheet value of the company being acquired, right? So this is an asset. We're going to say goodwill is an asset. I think it's a fake asset, but we don't have a useful life for goodwill. So how do we allocate costs for goodwill? And the answer here is we don't. We do not amortize, we don't depreciate, we do not deplete goodwill. Goodwill is an indefinite life, intangible asset, and we do not depreciate, deplete, or amortize goodwill. Okay? So it's a little, it sounds a little crazy, you know, like we're not going to allocate this cost in some way. Well, what we do instead, in place of amortization or depreciation or depletion, we're going to test this asset's value for impairment every year. All right, so that's what we do instead. So when we talk about allocating costs, whether it's depletion, amortization, depreciation, there are different methodologies that we can use. And they fall into two broad categories. The first is a time-based method where we simply say we think this asset will last 10 years and we allocate the cost across those 10 years equally. But we could also have a activity-based method, and what this activity-based method says is rather than using time as your basis for allocating costs, let's use how much activity. Well, we think the pizza oven that we bought for Explorers Den can make 1 million pizzas. And so if we made this year 50,000 pizzas, then we can measure our depreciation on that pizza oven by using 50,000 pizzas divided by 1 million pizzas, and that will give us a percentage of that oven that we used in the current period. And so we would call this an activity-based method. All right, so two methods: time-based, activity-based method. All right, well, this concludes the video for Learning Objective 2-1. Thanks for watching. I hope you found this video helpful. Take care.